Hello everyone, my name is Bridget Ryan. I will be going over Chapter 8, Individual Income Tax Computation and Tax Credits, specifically going into Alternative Minimum Tax, Lesson 8.2, pages 8.8 to 8.12. I'll be covering some key concepts on what is the alternative minimum tax, going into components and how to find that. So we have our AMT base, our AMT exemptions, and our AMT rates. We'll touch base on percentages used, how amounts are introduced, and what each component represents in finding your AMT. All filing statuses are used for exemptions. You have a percentage of each dollar of alternative minimum taxable income threshold, which will be phased out. We have two separate tax rates based on filing status and income. So we'll go into details about all those components. Your alternative minimum tax is your secondary or parallel tax system. This ensures high income level taxpayers are subjected to a fair share of taxable income. It can be perceived by the public they are benefiting from tax preference items. So these items can include exclusions, deferrals, deductions to reduce or eliminate tax liabilities. So our alternative minimum tax really is here to ensure that everyone has some minimum amount of income tax each year. It was designed in 1986 to ensure this. The picture describes how the AMT formula is set up. So as you can see, there are separate components that we touch based on in our key concepts. We have our tax base, our rates, and our other components to figuring out our alternative minimum tax. Now, with that being said, we have to complete a regular return. So regardless if someone is subject to an alternative minimum tax, an individual would have to complete a regular return first, then complete a Form 6251. Then they would compare these two taxes. Now, if one is higher, that would be the tax that they would have to pay, that minimum tax of your AMT or regular tax liability. And it is hard to see if you're subjected to an AMT. Usually taxpayers are subject to it if they have more than 3 children, claim many deductions on their Schedule A, exercise incentive stock options. So the deductions that they might claim on their Schedule A, we're going to be kind of adding those adjustments back into our taxable income. So that brings us to our next step in our AMT computation. We go into our AMT tax base. And the formula for that is subtracting alternative minimum tax exemptions from your alternative minimum taxable income. So for that being said, your AMT base is going to be a little bit more inclusive than your regular income tax base, and taxpayers will only pay the AMT if the base exceeds their regular tax liability. So if you want to compute your AMTI, which is the alternative minimum taxable income, we compute this number by taking the regular taxable income the taxpayer has and add it to standard deduction, or add and minus adjustments onto that as well. So depending on how the individual computed their regular taxable income will help determine what is going to be added or subtracted back into their regular taxable income. The regular taxable income is given from your regular tax income, your AGI, your adjusted gross income, gives you your taxable income because you either subtract your standard deduction, you subtract your itemized deductions that are limited to 10,000. So whatever amount is given after that is your regular taxable income. And we need to know if someone is taking the standard deduction or itemized deductions, because this is critical in finding your AMTI. So for a standard deduction to be used, you're going to be adding that back into your regular taxable income. And for itemized deductions, it's going to give some more limitations than your regular itemized deductions are, because charitable contributions, home mortgage interest, and gambling losses have certain limitations on them. And I included a website that's going to give you further explanation, I felt, than the book did, and kind of some other research I did on this subject. Adjustments are very hard and complex to know what is going to be added or subtracted from your regular taxable income after adding in your standard deduction. So it does have common ones that you would get in your regular taxable income, like your medical and dental expenses are going to be more than 10% of your regular tax AGI instead of 7.5%. So there's going to be some differential differences between them. So I would definitely study and go into this. It's going to be kind of the more harder concept of this lesson. And I really emphasize on understanding adjustments, as they play a huge role in finding your AMTI. Now, say someone doesn't have any adjustments, they might not qualify for them. So if they don't, then they would just be adding in their standard deduction to their regular taxable income to determine their AMTI. That way, after they got that component of the tax base, they could go into the exemptions component. This is going to be based on filing statuses and income. So each filing status has an exemption amount that is deducted from their AMTI. In column 1, where it says exemption, that is automatically what will be subtracted from the AMTI. Now, if their AMTI is more than the phase-out amount, that is what's going to be subjected to a phase-out percentage. This percentage is always going to be 25%. So I have an example here that gives you a good look on how you get your alternative minimum taxable income and how you get your AMT base from exemptions after finding your AMTI. In this example, there wasn't a standard deduction taken in their regular income taxes, so they did not add standard deduction into there's actually itemized deductions that they had, and they were able to add in the itemized deductions of 10,000 because that's the limitation you have on regular taxed income. However, there is no limitations in computing AMT, so they were able to add in that other adjustment of tax exempt interest and give them a little bit more. Now, when you have your AMTI, you see that they're head of household. So I'm going to go back to this column right here, and it shows 72,900 is what they're going to take as their exemption. So that's why you got in line 2 that right there. However, their phase out threshold is 518,400. So because their AMTI did not exceed this amount, it's going to automatically be 0. It's a negative number, so you make it 0. It does not get times by the 25%, and they automatically just take the full AMT exemption. However, if the amount is in excess of the AMTI, so if the phase out threshold is this amount and say your AMTI is 700,000, there's going to be a balance there. That balance is what's going to be times by 25% to get your exemption phase out amounts. And now when you have your exemption phased out amount, you're going to take your full AMT exemption minus that phase out amount to then get what your AMT base will be, because that will determine your exemptions. So you would take line 7, subtract it from your alternative minimum taxable income, and that's going to get your tax base right here. So it is very important to know the exemption amounts, the phase out period, but there is only one percentage, and that's going to be 25%. After finding your base, you're going to get your tentative minimum tax. Now, this is the final step in finding your alternative minimum tax, because you take your AMT base times our AMT rates. Now, I touched on our rates only being 2 separate ones, and this is going to be based on your filing status and income. So if you see right here, this tax base is going to be $82,250. So we're going to take that $82,250 and compare it to our threshold. So for our AMT rates, our threshold is going to be $197,900. If a taxpayer, except married filing separately, is below that amount, they will automatically times their AMT base by 26%. Now, if it exceeds $197,900, so going back, this number right here exceeds that threshold, it will be times by 28%. Now, for married filing separately, it's going to be different. To get that 26% AMT rate, you would have to be below $98,950. And if you're over that, that's what's going to be times by 28%. Now, what's really important about tentative minimum tax is if there is dividends included, so they were taxed at a preferential rate in your regular taxable income, you would have to subtract that amount to get your AMT base. That would be times by your percentage and given your threshold as well. So if you have a dividend, after subtracting it out, timesing it by your rate, you would then have to add in the tax on that dividend. Those taxes are same as the regular income tax. It's going to be 0, 15, or 20% depending on filing status. Please go look at lesson 1. It gives a clear understanding of who and what percentage they use on dividends. After that is added back in, you get your tentative minimum tax. And after you get your tentative minimum tax, we then take our regular tax liability. So this is going to be your total tax liability, as you see here, computed. I took this from lesson 8.1, so this is a great example on how the tax on taxable income was computed. We then move that number here, and because it exceeds our tentative minimum tax, there is no alternative minimum tax paid. So you would not be subject to this. Now, if for whatever reason this said $20,000 and your alternative minimum tax became $1,308 and your total tax liability was only $405 on your regular taxable income, you would then have to pay this alternative minimum tax of $1,308 over that $405. So the purpose of this is to really ensure that high income earners are not cutting themselves tax breaks and are paying their fair share of minimum taxed income, and being able to make sure that we are not subjecting high income earners to less income tax than low income earners. It recalculates income tax after adding certain tax preferences items back into AGI to ensure these taxpayers paid this fair share. We want to stop them from escaping tax breaks, and unfortunately will cause a tax bracket creep for our upper middle class who may be subject to an AMT. So thanks so much for listening. I know this was kind of fast, so I hope you enjoyed it. Please leave comments and look forward to hearing your feedback. Thank you.